I want to talk about my overnight range setup for the opening trade, the regular market open trade. And I have been using this for the last month or so, and I'm using the overnight extremes of the market to determine if my opening trade should be a long or short. So I have some rules here. So the overnight low or high is established between 6 p.m. and 4:45 a.m. Central Time. We are looking for the high and the low that was traded during the overnight session or pre-market session. Then we're going to use wicks and tails to determine when we want to take that long or short. We're going to use volume profile as the second confirmation for when we want to take our long or short, our entry. And then, if possible, we use the previous day's high or low to also come into play. In market trading, we always have to remember that we have a priority of inputs. We have a variety of inputs too. And we need to be able to prioritize where those inputs are. Otherwise, we're going to get confused. So I've determined, at least for my setup, that the overnight high and low is my number one priority. My wicks and tails are going to be where my entries are, so a second priority. And then the volume profile. And finally, previous day is for my fourth priority of input. I've tested this on NQ and ES using the 15-minute charts. It does not seem to work on other indices or, like oil or gold. I've not seen a reliable pattern for that. And this could be one of those things where it's going to work and we don't know how long it'll work, and then it won't work anymore. It does seem like Europe has a big influence in this, that overnight session, maybe Asia, I'm not for sure, but I think it's Europe. And who knows, maybe Europe will start trading differently in the next month and this won't work anymore. But the goal of this is to know, do I take a long or a short on the market open? Rule number one, no shorts if the price is trading above the overnight high. So in this example, overnight high was established down here at almost the beginning of the session, even before 6 o'clock actually. And it traded, and then we have the overnight high established at 4:45. We got a little red candle right here. Price traded up through. Market isn't open yet, but we've got a ton of price action up above here. Market opens on this green candle, bounces around, comes down, and this is where we would be very tempted to take a short. But our rule is no shorts because we're trading above the overnight high. So we're just looking for an entry to get in. So sure enough, we got a little, and this is where I sometimes kind of mix in maybe a little bit of ICT concepts where you might trade gaps or displacement or something like that. I barely understand what they're talking about. So don't take what I say here as the truth or correct, but I believe there was some kind of displacement and maybe a gap there, an imbalance, things like that. But what I notice here is we got this red candle, leaves a wick right here when that closes in this area, right along this value. And I'd be immediately looking, okay, I can get long here. I've got a wick here, got a little bit of imbalance here. This would be like just golden for me. Plus volume, we got a low volume node right here. So take a long and ride it up. So that's rule number one. Rule number two, if price trades back under, then we're looking for shorts. So in this example, while it's extreme, so we had news here. And what was interesting about this day was the previous day news came out and price just shot up and just ran. In this case, news came out, price was above the overnight high, but it rejected. We got a nasty long wick here and came back into the area, back under the overnight price, and it ended up being a short day. One thing to keep in mind is if price never traded down below this low area, then we maybe be an inside day instead and don't just hold on to the downside. Failed auction. Again, this is another example. Price, the overnight high was established. We got a wick. We had a failed auction to the upside. So that's on our plate. We're looking for shorts. The market opens I believe in this candle right here, comes down, and who knows, there was maybe some structure here in the previous day or whatever, why this rejected, and then trades back up. But again, since we have this failed auction here, we don't want to stay married to this long, if that were to be the case. And price actually traded back up inside the overnight low. So at this point now we're looking for an inside day. Wicks and tails. So I find this to be more true than not. I'm not perfect at it, but what I notice here is we got a green candle here, red candle here. Again, 15 minutes. And what I will do is I'll draw my box between those two wicks. And I have my box set up to automatically put a 50% line in there. And my entry will be on that 50% line. My stop will be right above this red wick, or maybe a handle above it, just in case price actually traded through and then rejected, took stops out. But this has worked for me again and again. And you can see down in this example, I didn't highlight it here, but we got a red candle here, a tail, another tail. And what's happened here, and this is the other part I see. So probably the safest thing to do is trade, maybe that wick, but that's a lot of risk there. So I like, if I can, if there's a gap here, then I put my box there. Whereas this one, you can see there's a very little gap here. So if I were to take this, I wouldn't take it on this candle. I would wait for that candle to close and see, okay, I'm going to take 50% of that wick, which aligns with these two wicks here. So then I would take a long there and trade that up out. But the point of this is how to get in. Where do you get in on this movement? So that's how I use those. And there's probably someone else that can explain it better, but it's just something that I've come to really trust on the 15-minute candles. Volume profile. Now, I've referenced Top Step. They have a great article about how to trade the volume profile. But just a few things here. We got low volume here. We got a wick here. We got overnight high, again, failed. So when the price came back up into here, we're looking to get short again because of just all these confirmations again. Multiple confirmations, not just one single confirmation. Previous day, high and low. Here again, we trade up. So we've been on a multiple day run. Now price trades up outside of the overnight high. But again, we're always looking for how long will that trade last, because we don't know. And we don't know what we don't know. So, if price jumps up here, we get a nice long wick. What does that mean? We don't know. But now we can see here that this is the previous day high, and we had a stop run, try it again. And so we know that's a failed auction. We're going to get short on that. Now, I want to bring some examples of longs in more detail. So news release happened. Boom. So now we're down here. We trade this overnight low and a couple times, and it seems to hold. Price shoots up, and now we need to look, how do we get in? Because we got to get in long, right? And this is all still before the open. So market open, this crazy candle here trades up hard, and then we get a little bit of pullback. So we'd be very tempted to take a short here. And I suppose you could if you're fast enough here, but here's the risk. This is a pullback. This is not a market direction. And this is where people get short and don't realize when to jump out. So in this case, if we stick with our rule, we're saying we're not going to get short unless we were to trade all the way back down below the overnight high. So in this case, we see a pullback. We see this candle, this displacement. We see volume kind of trading to the other side of the volume node right here. And this is where we get long. And we don't hold on to a short here. We say, nope, it's all long today because of our rule. Now, we could be wrong, but that's okay. We're not breaking our rule. The market might actually not follow that rule in this case and may try inside, and that is okay. That doesn't mean that we're a bad trader. It doesn't mean that the rule doesn't work. That doesn't mean it's a bad plan. And I think this is what got me super confused for many years, but this is my rule that I'm sticking to, and I've tested this rule and it works for me very well. Not 100% of the time, And if it doesn't work, that's okay. I don't need to feel bad about that. I won't feel bad about it because I stuck to my rule. Here's another example. Price trades up above, the market opens, and right again, I'm looking for this structure here to get long because price is above. We don't have any rejection wicks here. That's a very key thing. Price was trading. We got normal wicks here, nothing rejection whatsoever. Price trades down into here on 15-minute. And there's a wick right here. There's a little bit of, and this right here, and here, some would consider a resistance that turns support. And that's kind of more of a classic old model. But again, we get long, we stay long. Retest. Here's another example. The overnight high was here. Price comes up. Market opens here. Comes back. Tests. Again, our rule says only longs, and we write it out. Now, a couple failed ones because we want to know, what does that look like so we understand how that works. So, price 445 overnight high. Price is dancing around this, dancing around it, trades a tick above it, and rejects. And we see this big rejection bar right here. It'd be nice to ride that if you wanted to. You technically probably could get that because on this candle, it traded a tick above. Now, this is, 6:37 a.m. if you're trading at that time, and you could get that. If not, that's fine. But if you're trading at the open, we got this giant red bar here. It trades below price. Now, this one is tricky, I will admit, because we're trading below the overnight low, and then it comes back up inside. So either you say, this is not my day, I'm out, or you adjust and flip and say, nope, I'm going to trade my rule. I can trade this. And when the price trades up inside, and it didn't trade up to and reject, that's the key thing. It traded up into it and closed up above. Price came a little down and filled this area, and that's fine. That doesn't mean it's invalid. And then you could get long and trade up to here. Another failed. So here we are above. Price is dancing all over this place. Crazy news. Market opened here, trades down, trades into the overnight low, takes it out by a tick, and then rejects. So again, we got this wick here, we got rejection. So at this point we go long because the overnight low held, and we can ride this out. And maybe this would be a rough one. I don't deny that because price was up above here, but really, here's the thing. On a 5-minute or 1-minute chart, it's going to look like price is trading above this overnight high, and that's true. But on 15-minute candle here, it's actually not trading above it. It's trading around it. And I don't know, maybe that's a distinction, maybe it's not, but maybe it's me just trying to justify my setup, but it feels like it works here. And it feels like it applies. Now, in this case, this day was awesome. So not only did we trade up above on the extreme side, we trade down through the extreme side, we trade back up, and then we have a failed auction. And everything just flips out. And I believe this was the day the bond auction failed. And so, it went short, crazy short. But what I think here is all this action had traded through, and it set things up so that this could sell off like this. But again, it gives me some anchor points. Always when I'm trading, I'm trying to find an anchor point so I can stay anchored, so I can stay centered. As our dear friend Hogue says, gotta stay centered. So that's what I have as examples. There's more. You can take the short side and all that. The same applies. I talked mostly on the long side, but you flip it around. Same thing applies to the short side and all that.